In the realm of high finance, few tales are as captivating and cautionary as the rise and fall of long-term capital management, or LTCM. This hedge fund, which once stood as a beacon of financial innovation, ultimately became a stark reminder of the perils of overconfidence and excessive risk-taking in the financial world. Founded in 1994, LTCM was no ordinary hedge fund. It was a revolutionary force in the financial industry, promising to change the way investments were managed and profits were generated. Its founders were a veritable who's who of Wall Street, including renowned bond trader John Meriwether and Nobel laureates Myron Scholes and Robert Merton. These individuals brought with them a wealth of experience and a reputation for brilliance that few could match. Their collective brilliance and groundbreaking application of mathematical models to financial markets promised to revolutionize the world of investing. They believed that by using advanced mathematics and sophisticated algorithms, they could predict market movements with unprecedented accuracy. LTCM's innovative strategies, rooted in complex arbitrage and derivatives trading, attracted billions from eager investors seeking outsized returns. These strategies were designed to exploit small inefficiencies in the market, generating profits that seemed almost too good to be true. These financial wizards believed they had cracked the code to consistent profits. Their confidence was bolstered by their early successes, which saw the fund generating returns that far outpaced the market. Their models, based on sophisticated algorithms and historical data, seemed to predict market movements with uncanny accuracy. This gave them a sense of invincibility, as if they had discovered a secret formula that guaranteed success. LTCM's early performance only served to reinforce this belief, generating returns that left even the most seasoned investors in awe. The fund's success attracted even more capital, as investors clamored to be part of what seemed like a sure bet. The fund quickly became a Wall Street legend, its name synonymous with financial ingenuity and unparalleled success. It was hailed as a model of what could be achieved when brilliant minds and cutting-edge technology came together. However, beneath the surface of this seeming invincibility lurked a dangerous combination of overconfidence and excessive leverage, setting the stage for a dramatic downfall. The very strategies that had brought them success also exposed them to enormous risks, and when the market conditions changed, the consequences were catastrophic. The story of LTCM serves as a powerful lesson in the importance of humility and caution in the world of finance, reminding us that even the most brilliant minds can be brought low by hubris and the unpredictable nature of the markets. From the outset, LTCM exuded an aura of exclusivity and success. Founded by a group of elite economists, including Nobel laureates, the firm quickly became synonymous with financial brilliance and innovation. Its Greenwich, Connecticut headquarters became a magnet for some of the brightest minds in finance, attracting top talent from prestigious institutions and Wall Street powerhouses. All eager to be part of this seemingly unstoppable force, these professionals brought with them a wealth of experience and a hunger for success. The atmosphere was electric, charged with the promise of groundbreaking achievements and unparalleled financial gains. Early investors, ranging from wealthy individuals to institutional giants, clamored for a piece of the action. They were drawn by the allure of LTCM's sophisticated strategies and the promise of extraordinary returns. Entrusting their fortunes to LTCM's quantitative prowess, these investors believed they were part of something revolutionary. The firm's complex mathematical models and algorithms were seen as the future of finance. And for a while, it seemed their faith was well placed. LTCM's strategies appeared to be infallible, consistently delivering eye-popping returns that defied market fluctuations. The fund consistently delivered eye-popping returns, exceeding even the loftiest expectations. Investors were thrilled, and the financial world watched in awe as LTCM seemed to have cracked the code to perpetual success. Defying market fluctuations and exceeding even the loftiest expectations, LTCM's success was attributed to its ability to exploit even the smallest discrepancies in market pricing. Using complex trades to generate profits from these inefficiencies, the firm seemed to have mastered the art of turning minute market movements into substantial gains. Their models, they believed, had eliminated much of the risk inherent in traditional investing. Their models, they believed, had eliminated much of the risk inherent in traditional investing, creating a seemingly foolproof system for generating wealth. The confidence in their strategies was palpable, and it seemed nothing could go wrong. Creating a seemingly foolproof system for generating wealth, LTCM's approach was hailed as a new paradigm in finance. The firm's success was not just a matter of luck. It was the result of meticulous planning, rigorous analysis, and a deep understanding of market dynamics. Creating a seemingly foolproof system for generating wealth, LTCM's approach was hailed as a new paradigm in finance. The firm's success was not just a matter of luck. It was the result of meticulous planning, rigorous analysis, and a deep understanding of market dynamics. Years of consistent outperformance fueled a culture of invincibility within LTCM. Confidence morphed into hubris, and the potential pitfalls of their highly leveraged positions were largely ignored. The firm began to take on more risk, believing their models could handle any market condition, and the potential pitfalls of their highly leveraged positions were largely ignored. The firm began to take on more risk, believing their models could handle any market condition. However, the financial markets are unpredictable, and even the most sophisticated models can fail. The seeds of LTCM's downfall were sown in their overconfidence and the belief that they were untouchable. At the heart of LTCM's strategy lay the double-edged sword of leverage. Leverage in the world of finance is a powerful tool that can transform the landscape of investment strategies. It allows investors to borrow capital, thereby amplifying their potential returns. However, this amplification works both ways, magnifying not just profits but also losses. The allure of leverage is undeniable. It promises the possibility of extraordinary gains, but it also carries the shadow of devastating losses. Leverage, in essence, is the use of borrowed capital to amplify potential returns. This concept is not new. It has been a cornerstone of financial strategies for centuries. By using leverage, investors can control a larger position than they could with their own capital alone. This can lead to significant profits if the market moves in their favor. However, the flip side is equally true. If the market moves against them, the losses can be equally significant, if not more so. While it can magnify profits, it also carries the inherent risk of magnifying losses. This dual nature of leverage makes it a high-stakes game. Investors must be acutely aware of the risks involved and have a robust risk management strategy in place. The history of finance is replete with examples of both spectacular successes and catastrophic failures due to leverage. It is a tool that must be wielded with caution and respect. LTCM took leverage to unprecedented levels, believing their models could navigate the financial markets with such precision that the risk was negligible. Their confidence was rooted in the sophisticated mathematical models they developed. These models were designed to predict market movements with a high degree of accuracy. The team at LTCM, composed of some of the brightest minds in finance, believed that their models could effectively eliminate risk. This belief led them to take on massive positions in various markets, betting billions on their ability to predict future price movements. They leveraged their capital to the hilt, taking on positions that were many times larger than their actual capital base. This strategy worked well for a time, generating substantial profits and solidifying their reputation as financial wizards. However, the very leverage that fueled their success also set the stage for their downfall. For a time, this high-risk, high-reward approach paid off handsomely. LTCM's returns were the envy of Wall Street. Investors flocked to the fund, eager to share in the profits. The firm's success seemed to validate their approach, reinforcing their belief in the infallibility of their models. However, this period of prosperity was not to last. The financial markets are inherently unpredictable, and no model, no matter how sophisticated, can account for every variable. However, it also exposed LTCM to catastrophic losses should their bets go awry. The very leverage that had amplified their gains now threatened to magnify their losses. The financial markets began to move in ways that their models had not anticipated. The assumptions that underpinned their strategies started to unravel. As the market conditions changed, the positions that had once been profitable turned into massive liabilities. The fund's reliance on mathematical models, while innovative, ultimately proved to be a critical vulnerability. These models, while sophisticated, were built on historical data and assumptions about rational market behavior. They did not account for the irrationality and unpredictability that can characterize financial markets. When the markets deviated from historical patterns, the models failed to provide accurate predictions. These models, while sophisticated, were built on historical data and assumptions about rational market behavior. They assumed that markets would behave in predictable ways based on past performance. However, financial markets are influenced by a myriad of factors, many of which are unpredictable. The models did not account for the possibility of extreme events, known as black swan events, which can have a profound impact on the markets. What they failed to account for were the unpredictable black swan events that can send shockwaves through the global financial system. These rare and unforeseen events can cause massive disruptions, rendering even the most sophisticated models ineffective. The collapse of LTCM serves as a stark reminder of the risks associated with leverage and the limitations of relying solely on mathematical models. It underscores the importance of humility and caution in the world of finance. In 1997, the first tremors of what would become LTCM's undoing were felt with the onset of the Asian financial crisis. Triggered by a collapse in the Thai baht, the crisis rapidly spread throughout Southeast Asia, sending currencies tumbling and stock markets into free fall. The crisis exposed the fragility of many Asian economies and highlighted the interconnectedness of global financial markets. LTCM, with its highly leveraged positions in various Asian markets, was caught off guard. The fund's models, calibrated on historical data from more stable periods, failed to predict the severity and speed of the crisis. As losses mounted, LTCM was forced to unwind some of its positions, but the sheer size of their portfolio made it difficult to exit trades without further depressing prices, exacerbating their losses. The Asian crisis served as a stark warning sign that LTCM's seemingly infallible models were, in fact, vulnerable to unforeseen events.